Along with me today is Brian Wilson, who's been covering a lot of stuff while I was out floating around the South Pacific the last couple of weeks. And if you know, I should preface this with a sort of humorous statement. My wife and I joke about how her grandfather would go on these cruises, and then the family would have to sit through 400 slides because that's what it was back then. So I won't. I see Michael Doyle. Michael, good to see you. I was like, God, I know I can place that face. Nice to see you. So I won't do that to you. But if you have half a bit of curiosity, I'll show you just a little snippet of life on the boat. So I will not drag this out because it's not what you're here for. So these were actually in the Modern IR blog yesterday. Yeah. So this is what it's like in the South Pacific. By the way, this would be off of the island called Taha'a. So the Tahiti archipelago is like 118 islands, about 5 hours due south of Hawaii. And I'll just do this really quickly. But the water is really incredible. I mean, we've been in the water all over the planet, and this is as good as it gets. And it's very calm because they have big lagoons, but I'll just very quickly show you this. So it's like that. It's you're inside a lagoon, and the water is super clear, tends to be calm because of that protective move to what you're here for. It's good to be back, but I've been reluctant to give up the puka shells. This is the last day, then they go back in the drawer. Okay, so I've got 4 things that I want to talk about here quickly, and then I'll hand this off to Brian, who's been closer to the data. So I always come back when I have been away for a while, and it's a good principle for you too. There are going to be things that take us away from the market, and you have to, in my daily trading activity, if I'm going to be gone, I go to cash, as I did. I think the longer term, I hedged my portfolio before I left, long short based on the data. The model portfolio generally is intended to have longer time frames. What happens around options expirations, though, has an effect, and that's my first thing. Options expirations are turning points. This is looking back roughly a year at broad sentiment, and this is what I will always come back to. When I return, look at broad sentiment so you can get an idea of where everything is, and the past performance is no guarantee of future outcomes. A pattern in the past doesn't necessarily mean that what happened in the past will happen this time with a similar pattern. But I certainly look at the strength of demand and the trend in supply. And so this is where we are. We could say, well, probably things will be fine through an FOMC rate decision because demand bottomed into options expirations, which began yesterday. If you look at the supply side, certainly a rise, but that is now tailed off for 2 days. And you look at those conditions and you might say, well, let's compare them to another point in time. Perhaps you go back to, I go back to the last time that the Fed cut rates, which was right at December options expirations. And it occurred, and you see demand was falling. Supply had dropped to a post-election low of 44.4% December 5th. But you had falling demand, rising supply into options expirations was actually negative. The demand side was negative below 5. So it wasn't difficult to make a short bet there, which I did. And that turned out really well. Doesn't always. And the time to do those things is only at those inflection points, the turning points that options expirations present. If you're new, those are the little green squares. We have a calendar that's based on the Options Clearing Corp's calendar, and we populate the data set here so you know when those things occurred. Of course, you can't look ahead. You can always go look at the under using edge, go to go to resource or how it works, and that'll take you over to the landing page for Edge, and you can look at resources and see the calendars there. And I think the 2026 calendar is there. So the question is this going to be a turning point? I mean, if you looked at the demand supply relationship in the S&P 500, we're using as price SPY. Demand is a 10-point algorithm. We've normalized it to a 10-point scale, and it is taking the averages for the roughly 504 stocks comprising the S&P 500. Something I did trigger that, and that, by the way, reconstitutes tomorrow. I think there are 3 subtractions from it, 3 additions. I know Enphase is out of it, Market Access is out of it, somebody else is out of it, and we've added AppLovin, Robinhood, and I think MCore. And so that'll reconstitute. And you look at this and say, well, is this going to be a turning point? From a data standpoint, you would say probably not, but it does depend. I think it depends on whether demand, once again, gets back to roughly the red line. If it doesn't, you could say weak. Here's a period where we had weak demand during options expirations. You could look at this and say, what would have told us that this would be a difficult period? And you say, well, the fact that we were in the middle of these tariff wars at that time, and that might be a good explanation. And the market took a pretty hard turn there between monthly and month-end options expirations. I think that's right. Yep. So could that happen again? Well, sure, it could. I don't know what's going to happen, but if you look at the data and just take it at face value, you would say, well, certainly the conditions that existed in December don't exist now. You also don't look at it and say, well, this is going to be a booming big market rally. I don't see it off of these levels. That tends to come when we drop below the green line. Here being the big one in the this comparative period. And you could say here, after that event, then we had a market bottom and entry point, and we had a nice run. And you would know, right when we're above the red line, take your gains. The probability of additional gains diminishes. Not always true. This has been really quite an extraordinary period where converging demand and supply have not necessarily translated to a pullback. Certainly, it's been pretty predictive about when the market's gains slow down a little bit, but there's been a relentless propensity for the market to rise, which leads me to point number 2. How does this occur? How is it that the market just goes up and up? You say, well, there are more buyers than sellers. That might be the case, but there's a clear and fairly simple relationship that explains it. We've talked about this often. The money in the market is principally driven by models. I've mentioned how you can go look at the Morningstar fund flows data, and the top 5 passives, using July as an example, the data as of July 31st, gathered over $60 billion to deploy, topped by BlackRock. The bottom 5 with outflows were stock pickers. At the very bottom of the list, American funds, about $8 billion of outflows. Well, they're looking to sell stuff, and probably adversely. So if you're a passive investor, you have money to deploy, you will put it in big liquid things. And then you have machines that set prices. And we've talked about how the market has a propensity toward the 1, 2, 3 rule, right? Today, if the generally speaking, the S&P 500 goes up 50 basis points, and it pulls back. We've had a lot of volatility. If you go from the low of yesterday in the S&P 500 to the high thus far today, it's a 100-point swing. How does that occur? Well, it's the machines who set prices. If money's coming into the market, index options expire today. A lot of money's got to be re-benchmarked to the index. They'll move the price until the effort to buy slows down, and then they lower it. And the third piece of that puzzle, so you got fund flows, machine setting prices, and short volume, the capacity for market makers to change the supply and demand. And for those who don't know, we talk often about short volume. Short volume is the data set associated with what's called the modified uptick rule, Reg SHO Rule 201. There is a short selling rule in the marketplace. It's not what it used to be, where you could only short the market on an uptick. That went away in 2007. We had the financial crisis. There was a hue and cry to the SEC that we needed constraints, and they implemented in 2011. FINRA oversees it. Reg SHO Rule 201. Well, that data we can track it. The exchanges supply it, and FINRA supplies it, and we gather that data. What part of the market volume is short? Over half of it. I mean, it's just astonishing. But the market is that dependent on shares that don't really exist. I've explained this before. If Citadel, I'm just using them as an example, makes a bid and an offer in NVIDIA, and a trade comes in that is between them, if there is no underlying seller, Citadel will supply the stock. Well, where did it come from? It's manufactured. It is short volume. It's shorted. But why would the SEC do that? They want a continuous auction market so that our trades can always be filled. Well, it's a nice feature so long as you are aware that this condition exists in the market and that it presents risks. At some point, those risks will manifest. The market will, at some unknown future point, manifest the fact that there isn't enough liquidity and that half of the liquidity is artificial. It works great under most circumstances. Look at how well the market has done as demand roared out of this April bottom and has slowly weakened. Demand is weakening. It is. And on the supply side has been essential to how the market has risen. And it really depended on artificial liquidity here. It's funny, you could see it happen. I could pick a stock and show you, oh, there it was shorted to fill orders, and then they covered here. Sometimes adversely, most times not adversely. But you put those three things together, and it's why the market behaves the way it does. Relentless passive flows lift the market. Machine set prices. They have the capacity to create liquidity to make sure it happens. And so the market has a propensity to return to the mean and reflect an upward bias because money has to be put to work. So last thing I've got, I mentioned this. I've said there will be a shoe number 2. Well, I don't really know, do I? To this. I don't know if there will be. It's mathematically, if you look at, and this isn't necessarily the best way to think about it. This is a chart that shows volatility in SPY as a proxy for the market. That's the orange part of the graph versus the price of SPY from July 2017 to present. And what it shows is that you have periods that generally volatility rises when the market declines. Why is that? Because it's easier for money to get into the market than out of it. And why is that? Because the bid is always lower than the offer. So if pressure develops on the market, the bid and offer spread widens, and the market will have more volatility. It's more descriptive than it is predictive, but it's how the market works. As the market returns to the mean, volatility diminishes. And diminishing volatility tells you nothing about the health of the market. I mean, it's not a good you can't look at the VIX and say, oh, it's at whatever, it's 15 right now, ish. At 15, that means the market is stable. Doesn't tell us anything. It only tells us after the fact. What has occurred. Here's one of the great points in time, and this is the greatest volatility event in the data set. But it will tend to have a precursor. Now there will be something that gives you a little canary in the coal mine indication. We haven't had it, right? We have not had that yet. Maybe it'll happen. You could look at any of these points where we had a pullback, and there'll be some little signal, like it jumped up here. You could go look through the data, and it will always be true that you'll get some little indication. So when I look at this, I say, well, there's no indication that it's imminent. On the other hand, there never is. So, when I said on CNBC that I thought at the end of Q3, perhaps the beginning of Q4, there could well be a shoe number 2. Why? Well, things have to rebalance. If you have a dramatic run, models will be overweight. We saw very little reweighting between April and present. Very little in June, and the next quarterly rebalance is now. I don't know. I'm just aware of these things. That's all. The last thing would be what's ahead, but I will stop there. And Brian and I can talk about that at the end. And we can, Brian, remind me, we can talk about model portfolios as well. So let me stop sharing.
Sure. And Tim, there's one question. There's one question from Brad, if you don't mind just taking a peek at that.
Yeah, Brad, what you got?
It's on the chat line. Yeah.
Okay. Okay. Let's see. So what does it mean when Rule 201 has been triggered on a particular ticker? Okay, good question. In RDW, and today there's an icon beside the same. Okay, so what that does is it pauses the trading. You probably noticed that. So when it's first triggered, shorting is paused and trading is paused, and you can't short that stock. That doesn't apply to the market makers. That's the problem. So if it's triggered, you would not be able to borrow that stock and short it until it's lifted. And I can't recall, I'll check to see what causes it to be lifted. But as I recall, all that has to happen is that it returns to normal trading, and then the restriction will be lifted. Now, if it's triggered a couple of times, then the extension of that prohibition is elongated. But again, if you're a market maker, those don't apply. Market makers are exempt from Reg SHO Rule 203b2, which governs locating shares to short. Broker dealers who are supplying them to customers are governed by those principles. Citadel et al. As market makers are not. And to me, it's a huge risk in the market, but then again, maybe it's not. What do I know? It would be, Candace, I think, as I recall, like the limit up, limit down, lulled girders that govern volatility in the market. It tends to be for a 5-minute period. If it happens again, then it's a longer period of time. If it happens a third time, it's for an extended period. And I'd have to go again. I'll check that. Those are good questions, you guys. I'll check the length of time of the 201 alt.
And Sev had one further follow-up question about options trading along the same lines.
That's a good question, Sev. I don't know if it extends to puts and calls. Honestly, no one's asked that question before, so I don't know. The options market. There's the CFTC footprint in it, and I don't know. So I'll add that to my list and come back to you. Good one. What else do you got that I can't answer? Okay, over to you, Brian.
Sounds good. Thanks, Tim. Go ahead and share my screen. I wanted to talk about a concept that I've mentioned a couple of times before, and that's just the concept of alignment between the broad market and big tech. And I'll give you an example of what was happening. So if we look at what was occurring at the end of August, and by the way, at month end, you can see a similar dynamic occurring. The last two month ends had a little bit of weakness. At the beginning of September, had a little bit of weakness from July into August. What I do, and you don't have to do this, you can just glance at the data, but I just keep a spreadsheet, and I wanted to share with you what was happening at the month-end time frame, and share what I mean by alignment. So if you look at broad market at the end of August, and you look at big tech, it was different. So the broad market had gone above 6, which is above our red line. The whole market was becoming a little bit overbought or stretched. Meanwhile, big tech was oversold. So there was a different dynamic in play. What do you think is going to happen with that type of dynamic? Well, trading's probably going to be pretty choppy. And that's exactly what occurred, August into September. We had a couple of up days, we had a couple of down days, but with big tech rallying, it was probably a pretty good indicator that you weren't going to see weakness persist, and that's exactly what occurred as well. You can see the next couple of days, the market started to rally. If we're looking at it, how is it aligned right now? To Tim's point that he brought out earlier, well, it's pretty good. Broad market 5-2, sentiment above neutral generally supports broad market advances. Big tech 6-6. Those are good readings. There's nothing wrong with those readings. There's nothing that tells us, with those readings that, hey, there's imminent danger here. But it's just an exercise that I do that's been helpful for me. And it's just as simple as, hey, what's sentiment right now in the market? Is it rising? And is big tech doing the same thing, or is it different? You don't have to jot it down on an Excel spreadsheet. I just do it so I can look back historically. Right now you would say the two are in alignment. It's a pretty good setup at this particular time. Many of those that are on this call, on this demo, know that I do this every day, but I'll take our momentum names, and what I'm doing is I'm just taking the names from our daily trading ideas. So the momentum portfolio, most of the time I drop low volatility in as well. I'll be honest with you, I don't like trading low volatility as much as momentum. But just for an example, today I took all of these names. That's what you'll see here on this little spreadsheet. And I'm just looking at these names at the end of the day. What am I looking for? Well, I'm looking for prices between the entry low and entry high. Right away, you're going to see names like RGTI, that's going to be out. QBTS, that's going to be out. So right away you can eliminate a number of these different names. And I have shared this on previous calls, and this is working pretty well for me. It's why I share it now. If we get towards the close, the exercise that I'll kind of walk through, and let's use Roblox as an example. I'll just see how it's trading relative. Sorry, I get part of the screen in my way sometimes. I'll see how it's doing relative to midpoint pricing. The premise is I'm trying to buy names that have underlying buy interest. Why am I doing that? There's a good chance that that underlying buy interest is going to then just keep bubbling over to the next day. Does it happen all the time? No, it doesn't. You can just use the simple rules that are in play if you want to. I'm taking it one step further. You don't have to do that. But as I'm taking it one step further, I looked back at my September trades so far. I've had 12 winning trades from daily trading ideas, and I've had 5 losers. So if I can limit my losers, and what I will generally do with my winning trades, I'll take half off the table at 2%, and I'll try to let a portion of the rest of that position run. And I've had a couple of names where that second half of the position has run, 5, 6, 7%. Now, granted, we're in a momentum market right now. It's not always going to be that way, but just an example of, how you can pursue some of these trades. I did want to share one trend that's happening on the passive investment side. This is a modern IR report. You've seen this report before. I think what's occurring with passive money right now is part of the reason that we've had this recently. What you're looking at is the S&P 500 and how it traded relative to midpoint price by the end of the day. We had 4 consecutive days where it was trading below the midpoint. So there was some underlying selling. Look at what was happening to investor interest during the last 5 days. It actually declined. And it was interesting to me. It's something I want to watch moving forward. You've heard me talk about passive money. It's really the engine of the market. The trend right now with passive money, it's the last 5 days, granted, but it's a little bit down right now. So there hasn't been as much passive money flowing into the market. That's part of the reason, for these red days. It's part of the reason why the underlying stocks really didn't do very much during the last 5 days. Interestingly enough, if you look at it from the SPY perspective, so what's happening with ETFs? That number's really down. It's down to 17%. So that's a dynamic that I want to watch coming out of expirations. Is this just a trend coming into expirations itself? If it persists afterwards, it's not a good trend. I think it's going to be difficult for the market to hold on to its gains if that continues. If you look at the SPY, what's been driving it recently? Actually, active money. So active money has been pouring in, helping the market to kind of stay afloat at this particular time. Tim, that was the topics I wanted to cover. Do you want to cover the model portfolio, and then maybe we can look at the what's ahead?
Yeah, certainly. And just to tack on to what you were observing there, keep in mind, indexes rebalance tomorrow. Doesn't mean they rebalance on the day, but they will have offloaded the responsibility to Goldman Sachs at all. The big bulge bracket handle most of that. Bulge bracket is a colloquial term that we in the capital markets use to describe the biggest banks, and they really dominate customer order flow. I mean, as I've mentioned before, 8 or 9 firms do that. So it'd be Goldman Sachs, J.P. Morgan, Morgan Stanley, B of A, Citi, and you can throw in a few European banks. They're the ones who handle all that stuff, and so they will help big institutions rebalance to track and model. Then they have to do something with that. I go back to Lloyd Blankfein famously saying that Goldman Sachs was in the risk transfer business. That's what he said. That's the business we're in. We take somebody's risk and transfer it to somebody else. That's what they do, and they're very good at it. So something can occur, and the consequences of it show up later. But these are little tells. It's why we look for those things. If there's a decline in passive flows and risk management flows, that's the combination we often see with ETFs, and ETFs are the dominant vehicle. We're going to look at that, and it should manifest, and it is manifesting in demand. Demand's rising, but it's pretty weak. It's not awesome. It didn't drop to 4 and then bounce to 6. It's hanging right around 5. And that's what you get when money is actually trying to leave. Now, I'm not saying that's going to happen, but we always look for those things around options expirations. Is why we say they're turning points. Now, to Brian's point about model portfolios, and Anesh, it will dovetail. I get that too, Anesh, that sometimes, you're like, every day, what I just bought yesterday, I'm supposed to exit, right? It's a model, so you have to keep in mind a model with 5 components where we're going to keep that thing at 5 is going to have that effect. I will do as you suggested. I've got a meeting after this with our data engineer, and we can go set the threshold at you got to keep 4 components. If you have to keep 4 components, it will naturally reduce the amount of turnover. The question is, does it impact your performance? If you're talking about 35 components, it's a different matter, but it's much harder to produce reliable returns at a certain threshold. You're seeing this everywhere with hedge funds, by the way. Hedge funds have returned money to customers. They've spun off and created different funds. They've funded external funds. It's all part of the size problem. The problem is, as a portfolio gets larger, it gets harder and harder to get it in and out of the market. So the advantage we're trying to run with these focused model portfolios is So far, our footprint's pretty small. Can we just run those and generate returns? And mathematically, the data have demonstrated yes. But that's my qualifier, Anesh. So then to your point, Brian, when the data, what data, you might say, when the data tell us we should, jump from this horse, the momentum horse, to a low volatility portfolio, look, those blended large cap blend model portfolios we were running, they perform very well too. Not as well as this focus momentum portfolio, which is up 37%, but they're up 19, 20% year to date, pretty good. But they're necessarily less risky. And if the data show us, if demand and supply and the trends in the low volatility and momentum portfolios and the supply demand trends across the market tell us we should shift, then we'll shift to a different model portfolio. We have them. This has been the best one to be in. And so we'll be prepared to do that. Okay. What's next? Is that what we're down to?
Yep.
Bitcoin. Exclude all the trades having on the. Yeah. So all we're going to look at, Brad, for those who listen to the replay, Brad asks, were your data on Bitcoin? The only data we have on Bitcoin is a Bitcoin portfolio that you can set up that will show equities. But the equities tend to be precursors for how Bitcoin itself will perform. Will your data include or exclude all the trading that is happening on the crypto exchanges, i.e. if I buy or sell some Bitcoin in Coinbase? Is that part of the data you see? We see the equity trading in Coinbase. That's what we're going to look at. But if you suppose that models that are trading everything are going to trade the equities knowing that there's a benefit. If they're buying Bitcoin, they probably buy the equities. If they're selling Bitcoin, they probably stop buying the equities. And so that's what we're looking for. There's that association, and it can be a pretty good signal. Just like tracking gold stocks is a pretty good indicator of what gold will do. And so you can set up a portfolio to do that. Yeah, it's interesting, Brad, on the 201 stuff. And I thought so, but it was interesting to look at the FAQs. Does not apply to trades outside of regular trading hours. And you see why stocks get absolutely hammered outside market hours when none of these girders apply, right? It's just, everybody who knows the rules and have built algorithms to conform to them know these things. Yep. Okay, next, and we'll wrap up with that. So Brian, I'll share my screen, but unless you want to. But my thoughts on what's next are fairly brief, and just be the data here. Here we go. So I just returned to where I started, and I'll look at demand and supply. I would shorten this. If you because the market moves episodically. We look at this all the time. But you try to measure the market over a longer period of time, it always mean reverts, because that's the nature of passive money and machines that want to arbitrage away any spread. Are ETFs trading at a premium? Well, we'll short the ETFs and buy the basket, and so on. This is going on. So if we look at a month, what's happened in the last month? Because it's kind of telling to zoom in and say, we had very low supply coming out of the August transition, and the market rose, sort of defying generally, there's not a strong trend in the demand side, but it's right at the red line, right? There is not an absence of demand. It's clearly there. But has the impact of this been felt? Well, I would say no. I'd look at that and say, is this the market makers who know that maybe people are going to rebalance through the September options expirations period? Look, I don't know what's going to happen, but you just look at the data and say, well, it's possible, right? If there's quad witching tomorrow and quarterly index rebalances and a new series of options trades Monday, could Monday be a bad day? I don't know. I'm not saying it would be, but I'm saying the consequence of this has been felt. The market rose. The model portfolio rose like, what was it, 17% over that period of time, and it really did well. Maybe I should go to C more often. So if there's going to be a consequence from this, it will be felt in the coming days, and or it's not. or it will be absorbed by options expirations and smoothed out by the risk transfer mechanism. But I'd look at that and say there is a risk. I said, I think the data would say there's the risk of at least one bad day. And I don't think we've had that yet. And I could be wrong. So, Brian, what do you think?
Yeah, thanks. I'll share my screen, kind of going along the same talking points that you just mentioned. And I mentioned this in my note this morning. We talked about it last week as well. What you generally see, think of shares being borrowed to facilitate demand. So there's strong demand in the marketplace. Shares are borrowed to facilitate that. Those who have borrowed those shares, what would they prefer to do? They would prefer to cover at lower prices. Doesn't always work out that way, but you see a period of short covering. What happens to the market? The market dips. You see shorts ramp up to facilitate demand again. You have a period of short covering. What happens? The market dips. You have a period of short covering right now. What's happened? Well, we had a couple of semi-weaker days. If short volumes continue to move lower, could we have continued weakness? That's certainly a possibility, over the next few days. I would watch out for just this transition from one cycle to the next. You can see what was happening in August. We generally had higher prices going into August expirations, and the general principle, if the market is moving higher going into expirations, it usually moves lower afterwards. Sometimes that's just for a short amount of time, but you can see how that played out in August. What's the market doing now? Well, it's generally been rising going into expirations. The general principle, central tendency would probably be a little weakness coming out of expiration. So that's what I see. I don't see the market imploding. It's not that type of market right now, but I would watch out for, potentially a little bit of weakness coming out the other side.
All right, Candace, I'm answering your question. And because I can only do 80% of one thing at a time, I can't type and speak at the same time. So Candace was asking, I might as well share it. Is there a good thing to read or learn about risk transfer? And I would just say, look, you actually have it already. If you can always zoom in like I did with the broad sentiment at options expirations, shrink your view. Look at the 30-day period and say, what are the demand supply fluctuations? The supply side has become unbelievably important. And of course, it's much less stable than the demand side. The demand side tends to move in a longer increment. The supply side is more unstable. It does tend to move like, 7 days up and 7 days down. I don't know why, but it's just, it's a central tendency we've seen. I would look at that into every options expirations period and use it as your risk management tool. You will look at it and go, well, okay, do I want to be more or less exposed to equities? I would look at this and say, I would want to get through Monday and Tuesday anyway, before I, bought into the notion that the market is off to the races again. So, and I think about that. I'm sitting on more cash right now as a result of options expirations and not knowing which way things are going to go. And I had long short hedge around the Fed meeting because I don't know. And it was very tempting several times today, but I knew I'd get gamed. Could I sell my long side? It's tempting because I can always reset it at the end of the day. You take that little bit of gain. But I know I'm going to lose that because the investment horizon of Citadel's is much shorter than mine, but much more informed than mine about that data. So in terms of risk management, that's it. Keep it very simple. Know that the biggest part of that's going to occur at monthly and month-end options expirations. Why? Because at the monthlies, the risk element. I was listening to a Barclays video today about this, by the way. They're quant risk management, and they were incorporating derivatives and a financing leg. But it's the same stuff. Why is Barclays talking about that? Well, because they do it, right? They're supplying it to customers. That's what they're doing. And so I know it's going to happen around monthlies, and then month end is when all those instruments want to be trued up to the benchmark in case they're asked. If the regulators come and say, hey, are you tracking your measure? You better have data that show that you're doing it. And generally, that's going to be a basket of options and futures. So you already know more than 99% of the people in the market by just looking at the demand supply balance. And we'll try to help you, of course.